Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show today, the Bank of Canada reads the tea leaves on the Canadian economy and stands pat. Life gets pricier anyway. Plus, housing affordability is an old problem. So where are the new solutions? And rethinking how to reward employees for a job well done. That's all ahead. First, for the week that was in business, it's time for the briefs. For the first time in a year, the Bank of Canada chose not to raise its benchmark interest rates, offering temporary relief for borrowers. Tiff Macklem reserved the right to raise rates in a month, depending on the path of inflation and economic growth.
Just because the Bank of Canada looks like it does nothing does not mean the Bank of Canada is not very busy right now, probably in overdrive, trying to assess just how much impact these prior hikes are going to have on the economy.
Central banks are closely watching jobs, looking for signs of softening in what has been an extremely strong labor market. Canada's job market was flat in February with a gain of just over 20,000 jobs. Wages rose at a faster pace of 5.4%. In the U.S., job growth was stronger than expected, but also moderated, possible signs that rate hikes are helping cool the economy. Canada's finance minister says the coming federal budget will reflect the current economic reality. Due in the next few weeks, this budget will have to balance the need for restraint and ballooning government debt and a central bank that's trying to cool the economy with the desire to be seen to offer immediate help to Canadians struggling with affordability issues. Freeland spoke this week as part of her pre-budget consultations. Smaller cities in Canada saw a dramatic surge in home values during pandemic and are now seeing the steepest declines in prices. Analysis from Desjardins shows that the steepest price drops in Ontario, for example, are in smaller centres like Windsor, Oshawa, and St. Catharines. Unfortunately, even with the price drops, the economists don't expect affordability to be much improved in those places. Canada's plan to ban single-use plastics like drinking straws and grocery bags faced off in a federal court against a coalition of manufacturers this week. The suit seeks to halt the ban and argues against the designation of plastic as a toxic substance. It's been called the biggest environmental case in Canada's history. A ruling by the federal judge could take months. The top execs from Canada's three largest grocers appeared before a parliamentary committee this week to answer lawmakers' questions about food inflation. A key aspect of the committee's review is whether the big three grocery chains are profiting from higher food prices, something all have denied, pointing to non-food items as the source of higher profit. There are also new calls for the grocers to break out their profit by division. And those are your business briefs. Well, our central bank seems confident that inflation will continue to fall, predicting that it'll hit 3% by mid-year. So is there relief ahead for borrowers on the rate front? Pedro Antunes is chief economist at the Conference Board of Canada. Thanks for being with us.
It's a pleasure. Thanks for having me.
So we know the central bank watches many things and there's lots of complex moving parts, but I wanted to start with that 3% forecast. The bank still thinks that we'll trend down to that level this year. What's your take on that? Does that seem like a realistic goal?
Yeah, I think monetary policy is having the intended impacts in Canada. We're seeing real estate markets falling, so that'll have an impact sooner or later on rental prices, hopefully, which is one of those factors that's still keeping inflation high. Mm-hmm. Wages are coming down year over year. They're running in the 4% range. That's good news. On the durable goods front, we've seen signs there that the inventories are high and prices are starting to drop. So, I think in Canada, for the most part, we're heading in the right direction. How quickly we get there, it all depends. There's a lot at play still. Mm-hmm. And the big question really is on food. So we'll see how that pans out in the next few months. And
sticking with some of those prices, we've said all along that much of the inflationary pressure was not domestically made. All right. We've seen global pressure coming from the war in Ukraine. We've seen high commodity prices. We've seen supply chain disruptions. Those are all still true, and some of them are still actually factors here. So can we see that some of those pressures will ease, or will they be with us for some time?
Well, I think if you look at shipping costs, they've come back down to pre-war levels. So I think some of these supply chain snags have been worked out. Mm-hmm. A lot of them were due to really excess demand for durable goods. Like we were just going crazy for household furnishing, recreational equipment and stuff, and that was just excess demand, and that's normalizing. And if you look at inventories, we're actually seeing durable goods inventories quite high, and prices coming down. And StatsCan actually talked about deflation among durable goods in the last reading. So I think for the most part we're seeing some signs that we are heading in the right direction. And then last, on commodity prices, we're back to, for the most part, back to pre-war levels. They're still high, yep. But hopefully that'll feed through, especially on the food side. We'll hopefully see those prices feed through slowly to the retail level.
So the bank pauses, and of course, it's reserving the right to resume raising if things don't go the way it wants. But what everyone wants to know, Pedro, those borrowers that are kind of struggling under these higher costs at the moment, is when you might see rates actually come down. Is it way too soon to start talking about that? Or do you actually look down the road and say you can see a day when the bank might actually relax a little bit here?
Well, I think it's important to keep in mind that where rates are today, the bank would consider them like essentially contractionary. They're taking away from economic growth, and as long as they stay there, they continue to take away from economic growth. So once the inflation problem is under control, we should start to see central banks talking about lowering interest rates. I think the situation for Canada will depend very much on what happens south of the border. Yep. Unfortunately, we just got news from Jerome Powell, the Fed's chair, that they're concerned about what's happening in the U.S. and in fact they might raise rates further. So unless the U.S. gets its house in order here in terms of inflation numbers, I think we need to be aware of what's going on there mostly.
All right, Pedro, so good to have you with us. Appreciate your time.
You're welcome. Thank you.
Pedro Antunes is chief economist at the Conference Board of Canada. Well, coming up, housing affordability is even more precarious for the growing number of Canadians who rent. That's next.